Welcome back. In our previous videos, we discussed why derivatives are attractive to traders and the various contracts available on Deriv. Today, we'll focus on the assets you can trade derivatives on, including both financial assets and derived indices. Let's start with financials. Deriv offers derivatives on a range of financial assets, including major forex pairs, stock indices, cryptocurrencies, and commodities. The diversity allows traders to engage with various markets and capitalize on different opportunities. Next up, we have derived indices. These are unique to Deriv and include synthetic and basket indices. Synthetic indices simulate specific real-world market conditions using a secure random number generator, while basket indices track the performance of groups of forex pairs or gold. Let's delve deeper into these offerings, starting with the basket indices. Basket indices provide exposure to aggregate performance of the underlying basket of assets. There are 5 basket indices available. The gold basket measures the value of gold against a basket of 5 global currencies: Euro, GBP, JPY, AUD, and USD, weighted 20% each. Forex baskets track the value of major currencies: AUD, Euro, GBP, and USD, against a balanced basket of 5 global currencies: USD, Euro, GBP, JPY, and CAD, each weighted equally at 20%. They allow traders to speculate on the overall direction of the basket. Basket indices help you spread your risk by not relying on just one currency. For example, the gold basket is a good choice if you're interested in gold but want to avoid too much exposure to the US dollar. It averages gold's value against 5 other currencies, which helps reduce the impact of any single currency's fluctuations. The same approach applies to Forex basket indices, which balance your risk across multiple currencies. Derivatives on basket indices offer a range of trading strategies, from speculation to hedging. This flexibility allows you to tailor your approach based on market conditions and your risk tolerance. Moving on to synthetic indices, first up we have volatility indices. These indices replicate how asset prices fluctuate at different constant volatility levels. They provide smooth and continuous price movements with appropriate price changes according to the specific index volatility. We offer volatility ranges from 10 to 100 for indices with 2-second ticks, and from 10 to 250 for those with 1-second ticks. You can choose an index with 1-second or 2-second ticks depending on your trading preferences. 2-second ticks typically display larger price changes per tick, while 1-second ticks show smaller, more frequent increments. Remember, there's no direct correlation between the prices of the 2-second and 1-second indices, even if they share the same volatility number. The numbers in the index name represent the level of simulated volatility, with higher numbers indicating greater volatility and larger price swings. Trading derivatives on these indices offers a more risk-averse approach than CFDs, as your risk is capped at the initial stake. Let's now look at the jump indices. We just discussed how the volatility indices simulate a constant volatility market. As an extension to simulate a market where shocks can happen, we have the jump indices. In a nutshell, the jump index is based on the existing volatility index methodology, with periodic larger than usual price jumps once per 20 minutes on average. These larger than usual price jumps occur on a magnitude of 30 times the normal volatility level. There are 5 jump indices available ranging from 10 to 100. Each number refers to the index's normal volatility level in between spikes or plunges. Each tick is generated every second. This results in constant volatility levels higher than the standard volatility indices. For example, the constant volatility of the Volatility 100 index is 100%, while for the Jump 100 index, it is around 137%. The highly volatile nature of these indices makes derivatives trading ideal, as they offer limited risk in your trading. Next, we have crash and boom indices. For traders seeking sudden price shifts, the crash and boom indices are ideal. Crash indices rise steadily before experiencing sudden drops, while boom indices decline consistently until a sharp surge occurs. Their names indicate the frequency of these events ranging from 300 to 1,000 ticks. For instance, a crash 300 index generally experiences a crash once every 300 ticks, though this is an average and not guaranteed interval. By using derivatives, you can explore various strategies to capitalize on the rapid crash and boom patterns of these indices. These indices exhibit higher volatility compared to traditional financial assets due to their swift price fluctuations. As a result, trading derivatives on these indices offers a more risk-averse approach than CFDs, with your risk confined to the initial stake. Moving on to the step indices, as the name suggests, these indices move in defined steps, with each step being a fixed value. There's an equal probability for the next tick to either step up or step down, creating a straightforward step-by-step movement pattern. This makes the index appealing to traders with both short and long-term strategies, offering a balanced and predictable trading environment. For those seeking more control over their trades, the step indices provide various options, with each number representing a specific step size. The standard step index has a step size of 0.1, while the step index 200, 300, 400, and 500 have step sizes of 0.2, 0.3, 0.4, and 0.5 respectively. These indices offer a low-risk alternative for derivatives trading compared to DERV's other synthetic indices. Finally, we have the daily reset indices. These indices, including the bull market and bear market index, simulate rising or falling markets over a 24-hour period. Each day, they reset to a base value, offering a fresh start. The bull market index tends to trend upward throughout the day and resets to 1,000 every 24 hours, while the bear market index tends to trend downward, also resetting to 1,000 at the start of each day. For lower risk trading, these indices offer greater predictability in their daily trends, as evident from their charts showing consistent uptrends in the bull market index and downtrends in the bear market index. At DERV, you'll find a wide variety of assets for derivatives trading, from financial markets to the unique derived indices. Each asset brings its own distinct characteristics and volatility levels, giving you the flexibility to choose the ones that best match your trading goals and make your derivatives trading journey exciting and tailored to your preferences.